Paul, someone asked for QSR, which is Restaurant Brands International.
Okay, let's check out what they own. Oh, wow, look at that drop. You see that, Sethi?
Let me pull up your stock here. There you go. Look at this. Yeah, look at that.
Okay, Restaurant Brands, the consolidation of Burger King, Tim Hortons, and Popeyes Louisiana Chicken.
All right, let's look at this. This is Restaurant Brands International, Paul. What's the market cap, baby?
Okay, 18.4 billion. PE of 33, so it's higher than 20, so that's an X there. But the profit margin of almost 11%, check mark, and they have a dividend of 3.4%. So what is that dividend? It's 500. Let's call it 600 million to be conservative. $600 million a year in dividends. So we want to make sure their free cash flow can support that dividend.
Let's look up revenue growth, which is pillar number 3, Paul.
4 billion to 5.6, and it looks pretty consistently growing. So that's a check mark there.
Nice.
Net income 375 to 643, another check mark there.
Very nice. So the PE is not so good, not terrible, 34, and we have 3 check marks so far. How about number of shares, Paul?
Well, oh yeah, number of shares. I'm sorry.
Yep.
Number of shares outstanding. How about number of shares outstanding? It's actually an X from 203 million to 268. I don't like that. And here's the other thing. Here's something interesting. Average diluted shares outstanding. It's usually never this big of a difference. So what does this mean? This means that if every single possible share could be executed and brought into shares, you would automatically be diluted again in half almost. That's not a good thing. I don't like this very much at all.
Okay.
So even if the company sold at a price I like, that's a big red flag for me.
Current assets over liabilities?
2.7 billion versus 1.6. So check mark there. And free cash flow. Remember, we need 600 million in free cash flow to justify the dividend. Free cash flow by year. Ready? Oh, so wait a second. First off, 1.2 billion to 1.4 billion. So check mark there. So 1.1, 1.4, 1.05, 1.35, 1.2.
Average is 1.2.
Okay, this is not a fast-growing company. The dilution really concerns me. So this is where we try to determine what kind of multiple we go off free cash flow. The dilution is a problem.
Let me slow you down real quick, guys. I like to bring people back around because we lose people on this one. So what we did is we found the average free cash flow of the company, which is 1.2 billion, right, Paul? Billion.
Yes.
And then
1.2 billion.
Our pillar number 8 is price to free cash flow. So we take that number, we multiply it by some number to determine the market cap that we want to pay for this company, and then we compare that to the actual market cap that shows the value of the company at the moment. And then we can see whether if this company is overpriced or undervalued, underpriced. Paul, what do you think?
So it actually seems underpriced because it's only selling for 15 times free cash flow. But the issue I have is those diluted shares. That's the issue I have. It's actually a reasonable free cash. Let's see how the last 12 months of free cash flow has been. Well, it's only been $1 billion. I mean, it's still not terrible. Yeah, I mean, I'm stuck on this one. If it wasn't for those shares outstanding, always increasing and so much dilution, I'd be in favor of this one. So it all depends on what the chances of those shares being executed are. And they stop freaking issuing more shares out, then it's actually not bad. So, I mean, it's not a terrible stock in terms of from the 8 pillar perspective. It's just not bad. It's just those number of shares outstanding are just